Hello and welcome to this IR Magazine webinar. The topic, how do Asia's award-winning investor relations officers engage with analysts? I'm Neil Stewart, editor-at-large of IR Magazine, speaking to you from New York City. Thank you to our sponsors, Archidin, a global conferencing provider which is handling the webinar technology, and IR Insight, that's the research arm of IR Magazine. On the line with me are two of the top-ranked investor relations executives in the IR Magazine Greater China and Southeast Asia Awards, which are held each year in Hong Kong and Singapore. Herald Wu from CapitaLand is talking to us from Singapore, and Angus Yiu from SmarTone is speaking from Hong Kong. Also on this webinar is veteran analyst Herald van der Linde in Hong Kong. He is HSBC's Deputy Head of Research and Head of Equity Strategy for Asia Pacific. Now let's start with a look at some data showing the importance of analyst relations. Here's a look at some numbers for IR in Asia as a whole compared to just the Asia Top 50. So that's the top 50 IR programs according to their scores across our awards categories. This comes from IR Insight, which oversees the research for our awards around the world. Now, if you're following the slides on the web, you can see that the average analyst coverage for all of the companies we've surveyed is 15. For the top 50, it's 21. In other words, a greater number of analysts correlates with better performing investor relations. Now, I say correlates, and I won't infer a cause and effect, but you can see a clear connection. A few more things to note here. A lower average budget for the top 50, so more analysts, but a lower budget. Now, one possible conclusion is that having more analysts means being able to take advantage of the corporate access opportunities they present, doing non-deal roadshows and investor conferences and so on. So less need to be spent on outreach by companies themselves. Indeed, note the greater number of one-on-one meetings averaged by the top 50 companies compared to companies overall. That's 341 compared to 211. 60% more meetings on average for the top 50. And of those, a slightly higher percentage involve senior management, 38% versus 32%. Next, it's interesting to note that more Asian IROs than in the rest of the world believe that analyst meetings have the greatest impact of any kind of IR activity. 25% compared to a global average of 11.3%, just 8% in North America. So analyst relations in Asia appears to be more important than perhaps even in the rest of the world. Which brings us to our objectives for this webinar, to explore what sell-side analysts expect from investor relations and how getting this interaction right will benefit your company and its valuation. Now, we're doing this in a tight time frame. We are very interested in questions from the audience. You can submit them at any time. You can type them into the box in the webinar screen, and we'll get to them in a few minutes. But first, let's meet our experts. Herald van der Linde has been with HSBC since 2005. He is currently the Deputy Head of Research and Head of Equity Strategy for Asia Pacific. Before this position, he was Head of Research for Taiwan and worked as an analyst and equity strategist in financial markets for 15 years in Indonesia, South Africa, and Taiwan. Now, Herald, you have been an equity analyst for many years and in many places across Asia and around the world. Briefly, how has the sell side evolved during your career, and how have you seen investor relations develop?
I think over the last 15, 16, 17 years almost that I've been an analyst. I started off in 1994. There are probably two large changes which have taken place. The first one is that the overall analyst competition has increased. There are more banks, more regional banks involved on the broking side, on the sell side. That has led to lower margins. People need to differentiate their products, and corporate access is part of that. The second thing I think is what has changed is that the regulatory environment has changed. So while 15 or 16 years ago it was very easy to get on the phone with an IR from a company, he made a couple of comments on how business was going, and we would put it on an email and disseminate it to the client base we had. That is absolutely impossible at this point in time. From an analyst point of view, fair dissemination of your reports, of information and your views is pretty much tracked now. And that needs to go back to the IR as well. So if I can then say what has been changing in the relationship between the sell-side analyst and the IR person is that one, it's the importance of simply getting access, corporate access, setting up one-on-one meetings with your clients, maybe providing access to senior management in those companies. And secondly, to be able to get the information from the company in a very much in a fair way. And what I mean with that, very shortly, is that if an IR has got something interesting to say, he should not do what we did 15 years ago and call the analyst and say, this is what the update is on sales from last month. But he's got to make sure that that is fairly disseminated, so it is public information, so the analyst can actually use this, and it is not private information for the analyst, because he cannot react based on that information alone anymore. So those are really the two changes: the importance of corporate access in an intensifying competition on the sell side, and the more structured way of how information needs to be disseminated.
Okay, thank you, Harold. A very good summing up of developments on both the sell side and investor relations and the relationship between the two. Let's go now to Harold Wu. He is Senior Vice President of Investor Relations at CapitaLand, one of the largest property companies in Asia. Harold won the award for Best IR Professional at the most recent IR Magazine Southeast Asia Awards in 2011. Now, in 2009, I'd like to mention Harold won Best IR Professional for all across Asia. Very good accomplishment indeed. So, Harold Wu, sum it up for us. How many analysts do you have covering CapitaLand, and what role do they play in relation to your IR program?
Good morning, everyone. We are fortunate, as you mentioned, because CapitaLand is actually the largest market cap real estate stock listed in the Stock Exchange of Singapore. So we have about 25 analysts that actually track us regularly. And of course, inevitably there's some turnover among the analyst fraternity as well. But we are actually pretty well covered. And I think we actively engage the analysts, not only on the sell side, but also buy-side analysts as well. So I think this is a very concerted effort by the management of CapitaLand, and I think it's very fortunate that IR is also seen to be a very strategic value by the top management of CapitaLand.
Now, Harold Vanderlyn mentioned the importance of corporate access for the sell side in this competitive environment. Now, Harold Wu, do you at CapitaLand use the sell side heavily in terms of non-deal roadshows and also investor conferences, luncheons, and so on?
Oh yes, very much so. We normally will hold a post-results luncheon after every quarterly reporting. And in terms of investors conferences, last year, for instance, I think we did about 10 investors conferences across the globe in the usual major money centers in New York, London, Boston, Amsterdam, Frankfurt, Hong Kong, Singapore, just to mention a few names. And of course, sometimes it's run on a back-to-back basis. We also do a non-deal roadshow in between the conferences as well. So for instance, just to give you an idea, we hosted something like about 500 over meetings with investors last year for CapitaLand.
An amazing 500 meetings. Now, I want to come back to you afterwards, Harold, and find out a little bit about how you prioritize those relationships with the analysts, how you decide whom to go with on non-deal roadshows. But first, let's go to Angus Yiu in Hong Kong. He is the corporate planning manager of SmarTone Telecommunications. Now, in 2011, he won the IR Magazine Award for Best Investor Relations Professional in Hong Kong. And SmarTone won the award for Best Investor Meetings in Hong Kong. So, Angus, tell us, how has SmarTone's analyst coverage changed in the time that you've been in IR at the company?
Good morning, everyone, and good evening to those in the United States. After I just joined the company several years ago, just less than 10 sales analysts who covered the company. Recently, the number is now 15, so it increased quite a lot in terms of percentage. As Mr. Wu just mentioned, SmarTone doesn't enjoy the market cap power to attract basically all the sales analysts in the market. So what we have been doing is to is to increase the number of sell-side analysts to a certain level. Basically, it's just a matter of resources management, time management, in order to optimize the balance between quantity and quality. Because if there is not enough number of sell-side analysts who cover the company, it may be a problem to reach a majority of the buy-side fund manager without a sufficient amount of sell-side analysts. But once the number of sell-side analysts come to a certain level, quality become more important because, if say more than 30 or even more than 40 sell-side analysts who cover a company, doesn't mean the marginal benefit or the marginal value doesn't mean anything. So up to a certain level, we are now more focusing on the quality that we serve every single one of them, to feed them with sufficient information, to update them timely, and also to basically put ourselves into their shoes to make sure that they understand our story.
Very good. Okay, so up to a point then, a company needs a certain number of analysts to make sure it's getting through to the buy side. But after a point, quality becomes very important, both in terms of your communications with them and, I'd imagine, in terms of the research that they're producing and the service that they're giving to both their clients and to the corporates. We would be very pleased to take any questions from our webinar audience. If you're viewing this webinar on the web, you can type questions into the chat message box and send to the moderators, and we'd be very happy to take those. But right now, I'm going to keep asking a few questions. Herald van der Linde, I wanted to ask you that when an investor relations team is seeking analyst coverage, when a company is seeking the right analyst coverage, what should they be focused on?
I think first they should be focused on making sure that they have good coverage among the key brokers. And with key brokers, I don't just mean the largest brokers, but what we've seen among the brokers in the industry is that there's been some differentiation in their particular focus. This comes back to what I said, intensifying competition on our side. You have what I call typically the supermarkets, the ones which are available in every country, in every sector, but you also sometimes got very much boutique brokers. So that's a focus. If you, for example, a resource company, you could think about focusing on some of the analysts in those resource boutiques as well. Then secondly, I think what's very important is make sure that you well educate them. Take time, in particular if it's a new analyst, to really explain the company and provide access. Let them see factories or come to a store or something like that, so that they're very well informed. What I think as well, which is very important, I would say almost, I cannot stress how not important this is simply the dissemination of information. If you want to make sure that the analyst can react to information which comes out of your company, make sure that it is public information. Make a press statement or something like that allows the analyst to use it. If you disseminate information on a limited basis, even if it's even an analyst briefing, compliance officers might argue that is not public dissemination, and as such, the analyst cannot react to that, and that information will not filter into the broader market very quickly. So I think it's also important not only to build that relationship and educate the analyst, but also make sure that you provide them with the right kind of information so that they can act upon it.
Now, if a company is small and illiquid and not being traded much by your clients, is there anything that they could do to still get you to pick up coverage? Is there a story that is so compelling that you would pick up coverage even for an illiquid stock, or is liquidity really the prerequisite for you to pick up coverage?
Liquidity for us is very important because eventually that's where we make our money. However, we do at times opt to select companies which are less liquid, and either that is because it fits in with the broader coverage plan we have. For example, if we would be covering telecom companies across the region, but there would be a less liquid and smaller Hong Kong name or Malaysian name or wherever it is, and it fits into the overall coverage plan for us, and it adds information to us, that would be one thing. So it could well be that the company has a niche focus which is of interest to us. Or it would fit into a smaller mid-cap product which we would like to have. Or we think it's simply an interesting company which is still of interest to selected clients of us. Some companies and smaller illiquids, but we have still some of our key clients being interested in this and are willing to pay us for information, updates, and a view on that particular company. What that company probably needs to do is to think about that a little bit and say, how do I fit into the broader sector? What do I have to add to these analysts? And part of that would be corporate access, and these companies maybe need to be more actively reaching out, making sure that they go to conferences, provide non-deal roadshows, participate in lunches which analysts might be organizing, or maybe organize them themselves. And also I think it's very important then to think about when you disseminate information. A lot of companies will do non-deal roadshows just after the results, and we just spoke about this with CapitaLand, a very large liquid Singapore company. Everybody would like to see them after the results, but if you're a smaller company, that is a very crowded time to go on the road. Maybe you go 2 or 3 weeks later when most of the company's been on the road, and that's an opportune time to actually get face time with investors. So you have to be a little bit clever on how you deal with that.
Okay, good. So some good advice there for smaller companies in approaching the sell side, in approaching analysts. Now, over to Herald Wu again at CapitaLand. And as I mentioned, Harold, I'm interested in exploring this question of how you kind of, in a sense, rank the analysts covering your company. Harold Vanderlyn just talked about how important it is to get the key brokers covering your company. That is not necessarily the largest firms. They could be boutique firms, but firms with certain strengths, perhaps in terms of their research or their distribution or their niche in the market. But in terms of when you look at your base of analysts covering CapitaLand, Harold, how do you judge, for example, who to go on non-deal roadshows with or whose conferences to attend?
Well, I think, first of all, obviously they publish reports, and I think we do, run through the report and really study it in quite depth. And the other thing is, because I actually do my own share registry analysis done every quarterly, I do know the in and out movement on my share register. But when it comes to the planning the non-deal roadshow, we actually leave it quite open to the corporate access to plan the meetings. But I think it's important that then the quality of the investors that they bring to us to meet, whether it's the right investor, I think after one trip you can tell. I think more importantly, post trip, there's also the feedback that they can get from the investor after the meeting. That's, I think, is very important, and that's additional value add, I think, to assess the corporate access and also the depth of the analyst coverage.
Okay, very interesting. So the looking at the quality of investors that they bring to meetings is a key element for Herald Wu and CapitaLand in judging their analyst coverage, not simply the quality of research or their distribution capacity, but the quality of those investors that they bring to meetings. Now, here's a question that I would like to ask all three of our panelists, and that's a common question that comes up. Would you ever go on the road with an analyst or with a sell-side firm that has a hold or a sell or an underperform recommendation on your stock? Angus Yiu, what do you say to that? Would you go on the road with an analyst who has a sell on your stock?
It's a real recent experience. We announced our interim results 4 weeks ago, and we went out to the road with a major sell-side firm, which has been putting a sell recommendation on us for the last 18 months. So recently they changed that a little bit to neutral, but in terms of the qualitative comment that they wrote in their recent report, it's still quite pessimistic, and that's nothing personal, and it's not any kind of a problematic issue in their report. But I'm just trying to point out is that the reason why we decided to go out to the road with them is because we would like to take the opportunity to tell our story over and over and over again to them. trying to share our management's views with the sell side firm, and also we also try to maximize the interface between us and the fund managers, and it is very important and also very valuable for the sell side firm to participate and witness the interaction between the management and the fund manager, because this is a very, very independent situation that the sell side analysts just sit there and observe the interaction, so that they do not only hear we to answer his own question, but he also hear what the fund manager is actually concerned about and how the management respond to those concerns, which is actually a very good reflection to what he believes in our story, and to clear or to clarify some misunderstanding that in his mind. So I think that's is a very effective way for us to actually to elevate our communication to this sell side firm to another level. I will put it that way. So I think
excellent.
And we will do it again going forward.
Excellent point. So it's an opportunity to educate that analyst, to improve the relationship with that analyst, so you're quite willing. And Herald van der Linde, what's your opinion of that? Do you think it's a good practice? Does it benefit the company and indeed your clients if perhaps you don't have a positive opinion on a company you're on the road with?
Yes, I have 2 points to make on this. First of all, an analyst's job is to judge your stock, but not your company. Of course, understanding your company is very important to that, but eventually the sell or buy or hold recommendation is based on the stock and the valuation of that stock and the valuation method they approach, etc. So I think I have at numerous times gone around with companies which I really thought were interesting companies, very well-run companies, and have no problem putting my money in it on a longer run. However, I have to put a recommendation on it on a 12-month basis, and if it run up by 30 or 40%, my recommendation would be a sell. So I think there's a difference between a view on a company itself and a view on the stock itself. Secondly, and this, in a sense I already mentioned this, a lot of these recommendations set on a 12-month basis, but the clients you're going to meet might have a very different time horizon. There are clients who look at stocks on an almost 20-year basis. There are clients who look at it on a 3 to 5 year basis. There are also clients who look at it on a 3 to 6 month basis. So based on different time horizons, you might have different views on what that stock should be. I might say on a 12-month basis I'm a sell, but I think actually if I would invest for a 3 or 5 year basis, I would definitely think this would be a buy. It's just that my rating system works as such. So I would say differentiate between what the analyst says about the stock and the company, and don't get too much hooked up onto the recommendations of the analyst.
That's an excellent point, Herald. Thank you. Yes, so the analyst recommendation is based on the 12-month period, and it's kind of a binary type of recommendation. It's black and white. There's no real gray area there, but buy-side clients are able to distinguish that gray area and may well have a much longer time horizon. Harold Wu, do you agree with that? Do you favor going on the road, or would you go on the road with a company with a negative recommendation?
Well, we certainly have gone out with brokers that has got a neutral or even an underweight on our recommendation of stock. And I really agree very much with Harold van der Linde when he says that, yes, analysts, I think, are paid to make a call, and it's basically based on valuation. But, investors, it comes in all shapes and sizes and with different time horizon as well. So that's a very valid point. And I think ultimately, I know investor relations mission is not to get as many investors as possible. I mean, to quote my former CFO, but it's really trying to get the right shareholder to invest in your company, hopefully for the long term, the shareholder that's going to be very much aligned with the strategic and business thinking and direction of the group. So, try and avoid hype, but, still that they can understand your business model and what is your competitive advantage vis-a-vis your peers. And hopefully, I think if that can prevail, then I think you have going to have a very loyal shareholder who is going to review, through the cycle. I think particularly for the industry that CapitaLand is, real estate does move in different cycles. There is such a thing as a property club. So, and I think one of the things that we're trying to aim to achieve is also to try and provide some stability to the earnings. And I think particularly because of the accounting treatment that befalls now on real estate, it is quite difficult. For instance, in Singapore, we recognize our profit on a progressive basis, but in other markets such as in China, development profits are only recognized on a settlement basis, on completion that is. So you're going to find this lumpiness coming in, which makes it very difficult for analysts sometimes to forecast, and certainly for even management to try and predict as well. And it's aggravated by the fact that we actually report on a quarterly basis. But it's a bit unfair to the developer, because really, by the time we put the spade into the ground, actually value is being created out of getting the approvals from the design during the construction. But you can't recognize it until it's fully completed, particularly for investment property, when you do a one-off revaluation. Yeah.
I see. So it's quite a nuanced story in terms of valuation for CapitaLand, and the analyst has to probably dig quite deep to get that full picture. Let me go back to Angus Yiu and ask you a question about getting feedback through the sell side, particularly, for example, after a non-deal roadshow or after meetings at an investor conference. Do you look to the sell-side firm, to the corporate access people, to give you feedback about how that meeting went, about what the investors think both of your communications and of your company?
Right. I think that's very important, and I always believe that the meeting is a two-way communication, not just like a one-way presentation from the management to the fund managers. Is the buy side or even the sell side analysts comment to the company, or also the industry, or also the market overview, are also very valuable to the company itself. So we always hope that the sell side analysts will get back to us with some comments or some responses from the fund manager that we just met during the roadshows, and something like not only the company valuation, but something like the management style, how the management look at the industry, how in the fund manager's mind, how they compare the company against the peers. Not just in the local market, or maybe on a global basis. These are all very important for the management to make that decision. So we always hope that we will get the feedback. Yeah.
Very good. Okay. Let me turn the page here and ask Herald Vanderlyn something. I've heard that some IR teams are working with sell-side firms and using video conferencing technology, even very high-end telepresence type of tools, to do virtual type of road shows and investor meetings. Do you believe that that's a possible replacement for face-to-face meetings if you do a video conference?
The short answer is no, but maybe. A couple of years ago, we had an instance. This was actually during an IPO of a particular company, whereby you might remember that there was the Icelandic volcano which erupted, and flights were disrupted. We had a schedule going on, and we were in the unfortunate situation whereby we had two management teams in different locations not being able to travel at that point in time. So we had to make extensive use of this kind of media. That worked actually fairly well, although we had some clients who did not have the appropriate technology. They had to go to an HSBC office in either New York or London or so, but that wasn't really a necessary problem. So I think this works very well. In the end, still, I think there is still value added if you go around and have a face-to-face meeting. Analysts have to do their own marketing as well. An easy way for us to cut costs is actually to do much more of these kind of video conferencing, but even on our side, it has proven that it doesn't work as well as simply a one-on-one meeting, face-to-face, in a location where the fund manager is located in his office. So somehow it does not seem to translate well. But I think it's something very easy to explore and maybe to use as an add-on to your IR package of tools. If you have an important announcement to make, you could ask a broker to set this up and do a conference call, but also, for example, do a video call. So it's something to explore. But I still think I'm not quite sure if it really replaces the travel and the one-on-one meetings.
So not a replacement, but perhaps a supplement. Certainly I've heard about IR teams, say U.S. IR teams, traveling to Asia, having one-on-ones in Hong Kong, but then doing a telepresence meeting with Australia perhaps, or with Shanghai, while they're there in Asia, in that time zone.
Yeah, that's a nice example.
Good. So a last question for Herald Wu at CapitaLand. Harold, with your company, you have done extensive overseas outreach. I know that you traveled regularly to the U.S. and to Europe. And in terms of using the sell side, do you have any tips to offer Asian companies about using the sell side for overseas outreach?
Well, as I said, because I actually do a very up-to-date share registry analysis of my shareholders, so I think you need that tool. Then you know where your shareholder base is and where they are. And if you can track that quite consistently, then I think you can make very good use of the corporate access of perhaps the larger firms who obviously will have a good span of influence, in those more established markets, to try and entice those particular investors to come and meet you when you're there.
Good point. Okay, so there are indeed sell-side firms in the U.S., in Europe, that are hungry to help take you on the road. They might be affiliates of your local contacts in Asia, or they may also be local firms, right, with their own clientele and base in those regions. Well, let's bring this webinar to a conclusion then and wrap it up. Thank you very much to Angus Yiu. He's in corporate strategy at SmarTone Telecommunications. Harold Wu, who joined us from Singapore, head of IR at CapitaLand. Both of those gentlemen are award-winning investor relations officers from our IR magazine, Greater China and Southeast Asia Awards. And of course, Harold van der Linde, head of Asia strategy for HSBC, talking to us from Hong Kong, representing the sell side in this discussion. Thank you, all three of you, gentlemen, and thank you also to our audience for listening. Thanks to our technology partner, Arcadin, and to IR Insight, the research arm of IR Magazine. Ladies and gentlemen, thank you and goodbye.